What are you buying when an app says USD, not Europe, not America? A relative price between two currencies, and that difference changes the risk question. On screen, watch the operator compare changing chart lines across two monitors. The footage illustrates attention to quotes, not a profitable signal.
The first check is the order of the pair. In USD, the euro is the base currency and the US dollar is the quote currency.
So if EUR/USD is 1.10, 1 euro costs $1.10?
Exactly. A quote is a conversion relationship. Last episode, leverage changed an ETF's daily objective. Here, leverage sits on top of a moving two-currency price.
Then separate two prices. Bid is what the dealer offers to buy the base currency. Ask is what it offers to sell it. The gap is the spread.
That sounds small enough to ignore.
Small isn't the same as irrelevant. It's a cost embedded in the quote before a directional idea has had time to work. A pip is a conventional small quote movement. Its value depends on the pair and position size. The chart monitor visibly redraws candles and lines as prices move. It is a picture of motion, not proof of a forecast.
Write down the pair, bid, ask, and position size before treating a screen as a plan. That sequence prevents vocabulary from doing the thinking for you.
But a correct quote doesn't make the trade sensible.
Right, it only tells you what the screen is asking you to exchange. The next question is how much borrowed exposure that screen is offering. That's why a correct label doesn't settle the exposure question. It isn't a personal recommendation, and it can't replace the account terms. Fenrir, take a plain example without turning it into a forecast. A screen can show a pair, two prices, and a chart at the same time. Only the pair tells you which two currencies are being compared. Only bid and ask tell you the executable sides of that quote. The chart may invite a story about where the pair goes next, but it does not remove the spread or tell you how a particular account handles orders. That is why this lesson begins with labels. If you cannot say which currency is base, which is quote, and which displayed price applies when buying versus selling, pause there. The CFTC's risk material is useful precisely because it sends the viewer away from the attractive screen and toward the real risks: leverage, dealer practices, and the terms governing the account. A quote is information. It is not a recommendation, a guarantee, or evidence that a trade belongs in your circumstances.
The reusable note has 4 columns. First, purpose. Are you converting money for a payment, managing an exposure, or considering a directional trade? Second, pair. Write it in the platform's order. Third, price mechanics. Record bid, ask, and spread at the moment you are comparing providers. Fourth, account mechanics. Identify the legal entity, fee schedule, and order or margin terms. That is not busy work. It prevents a traveler comparing conversion costs from accidentally using the mental model of a leveraged trader, and it prevents a trader from treating a provider's promotional rate as the whole cost. The sequence is purpose, pair, price, terms. Nora's calendar instinct applies even where there is no deadline. The order of questions determines whether you notice the relevant answer.
Erica, what about the word pip? It gets used like a magic unit.
Treat it as quote vocabulary, not a universal dollar amount. A pip commonly refers to a small standardized movement in a currency quote, but the monetary effect depends on the pair, the contract or position size, and the account specifications. That is the important correction. Someone can say a trade moved 10 pips without telling you whether that movement was trivial or consequential for their exposure. Before copying any example, inspect the pair, the size, and the account terms. A good educational habit is to translate every exciting unit back into the thing that actually affects you. How much money is at risk, under what agreement, and what could cause the position to close. Nora, give viewers the plain language check for a quoted price. Ask, what would I receive if I sold the base currency, and what would I pay if I bought it? The two answers should not be assumed to match. That gap is why comparing a headline exchange rate with the actual executable quote matters. It also explains why a viewer should distinguish an informational market rate from the rate a particular provider offers under its own terms. Neither is automatically suspicious. They answer different questions. The useful habit is to compare like with like, at the same moment with the same amount, and to ask what fees or spread are included. That turns a vague claim of low cost into a documentable comparison. Real quick, because this next part matters to you. If any of this is helping, tap that like button, then hit subscribe and ring the bell so the next one finds you. Both are free and take about a second, but they tell the algorithm to show this to one more person who needs it. Professor Marchetti, start with the distinction apps blur, deposit versus exposure.
Margin is collateral supporting a larger position. Leverage means the price movement applies to the full exposure, not just the cash placed aside.
So a small deposit can produce a large result in either direction. The accompanying phone clip shows a hand navigating a banking-style account screen, a reminder to read the account path before tapping through it.
That's the CFTC's core warning. Leverage amplifies losses as well as gains. Margin isn't a safety cushion that makes a large position small.
And the clock matters. A price can move before you have time to add funds, so the platform's margin terms and liquidation rules belong in the pre-funding read.
Can a platform just close the position?
Read its agreement for exactly that. Don't assume a general rule from a social post. Find the margin, liquidation, fees, and negative balance terms in the account documents.
Then check the counterparty. The CFTC advises verifying registration and disciplinary history. In the United States, NFA Basic is one record viewers can use for relevant registration and regulatory information. The footage shows two people pointing through a document together. Use that as the cue to locate the actual agreement rather than assume its contents.
First identify the firm, then open its records. Only after that compare the account agreement with what the app promised.
Nora's order matters because a clean interface can hide a complicated relationship. In retail Forex, the viewer should know who is on the other side of the transaction, what entity holds the account, and what rules apply when markets move quickly. That does not mean every platform has the same structure or every customer has the same protections. It means those differences are part of the decision. Read the customer agreement rather than relying on a creator's walkthrough. Look for how spreads are described, whether commissions or financing charges may apply, how orders are handled, and what the firm says about margin calls and closing positions. If the language is unclear, ask the firm to explain it in writing before funding an account. If the answer still does not make sense, that is useful information, not a cue to rush forward.
Leverage changes the scale of a mistake. Suppose a viewer focuses only on the amount required to open a position. That amount is not necessarily the full economic exposure. A movement in the pair affects the exposure, and the platform's rules determine when it may demand more collateral or reduce the position. The educational point is not to calculate a universal safe level. There is not one. It is to make the exposure visible before money moves. Read the exact contract specification, confirm the account's margin methodology, and identify the practical consequence of an adverse move. Those are questions a broker can answer about its product. A licensed professional can help a viewer decide whether such a product makes sense for their broader finances. Neither question is answered by a chart pattern alone.
So registration isn't a gold star.
Correct. Registration and regulatory records are verification tools, not endorsements. The reason to consult CFTC and NFA resources is to identify the firm and find relevant status or history, then compare that information with the name, website, and account documents in front of you. A mismatch deserves a stop. A record that is hard to locate deserves a stop. A platform asking you to send money somewhere inconsistent with the entity you verified deserves a stop. The practical move is not drama, it is documentation. Save the link, record the entity name, and make sure the agreement names the same party. That is how a viewer replaces social proof with a check that can travel from one platform to another.
Then set the order before opening the app. Verify entity, read terms, understand exposure, and only then decide whether the stated purpose belongs in this kind of account. Skipping to "what can I make" reverses the whole sequence.
Professor Marchetti, what is the practical red flag when a platform makes leverage sound like a benefit without explaining the loss path?
The red flag is an invitation to increase exposure without an equally clear explanation of how loss, collateral, and liquidation work. Marketing can describe access, speed, or buying power. The account agreement has to describe the operational consequence when the market does not cooperate. A viewer does not need to predict a price to ask these questions. They can ask the firm for the disclosure, find the section defining margin and close out authority, and identify whether costs can accrue while a position is open. If an answer depends on a circumstance the viewer does not understand, that is a reason to slow down and seek clarification, not to fill the gap with confidence.
Here's the mistake: treating every currency decision as a trading thesis.
A traveler changing money, a business paying an overseas supplier, and a person trying to profit from a quote have different problems. A purpose comes before a product.
For a travel or payment need, ask the bank or provider about the exchange rate, spread, fees, timing, and what happens if the rate moves before the payment.
And for a directional trade, the calculator and paperwork clip shows someone checking figures by hand. It illustrates comparison work, not a quoted exchange rate.
Write the downside in dollars before funding anything. Then ask a broker or licensed financial professional how the product, leverage, taxes, and account protections apply to your circumstances. That's a handoff, not a trade instruction.
The portable checklist is simple: pair, spread, leverage, counterparty, purpose, in that order.
5 checks. No crystal ball required.
Here's the transfer test. Imagine 2 people both looking at the same EUR/USD quote. One is paying a school or supplier invoice in euros next month. The other is opening a leveraged account because they think the euro will rise. The quote is the same, the decision is not. The first person needs to compare providers, timing, fees, and the effect of exchange rate movement on a known payment. Their bank or payment provider can explain its conversion process and charges. The second person needs to understand that a directional position adds a forecast, leverage if used, account terms, and the possibility of losing money quickly. Their broker can explain the instrument and its rules, while a licensed financial professional can address personal suitability. The shared number does not create a shared goal. Start with the purpose, because purpose determines which questions are relevant.
For a real payment, make a dated comparison. First, note when the money is needed. Then ask each provider what rate is being used, whether the displayed rate includes a spread, what fee applies, and how long the transfer takes. Finally, ask what happens if documents are missing or the payment is delayed. This does not predict the future exchange rate. It makes the current process legible. A business owner may also have accounting, contract, or tax questions that belong with their accountant, counsel, bank, or broker, not with a general video. The value of this framework is knowing when the next question has left education and become individualized advice.
For the directional trade, here's the honest first line: I could be wrong.
Yes. Put the loss scenario before the entry button. What movement would hurt? How much total exposure is involved? What spread, financing, commission, and account rule costs could apply? Who is the counterparty? Where can you read the liquidation terms? A viewer should be able to answer each question from primary account documents, not from a promise that a strategy works. If they cannot, the constructive action is to pause. Consult the broker for product-specific terms, your bank for conversion or payment mechanics, and an appropriately licensed professional for advice tailored to your financial picture. That boundary keeps an educational episode useful without pretending it can decide for a specific person.
Pair, spread, leverage, counterparty, purpose. Put those 5 words beside any currency screen. The same checklist works whether the app is colorful, the pitch is urgent, or the comment section is certain.
Fenrir's phrase about being wrong is the right ending because it changes the next action. When a viewer names a currency need, they can ask a bank, payment provider, or broker a concrete question about conversion, settlement, or product terms. When a viewer cannot name a need beyond hoping a price rises, the next question becomes more demanding. What evidence would justify that risk, and what loss could they genuinely absorb? This channel cannot answer that for an individual. It can insist on the records that make an informed conversation possible. Keep the quote, read the disclosure, verify the firm, and bring the actual terms, not a screenshot, to the person qualified to advise you.
And set a stopping rule before the money moves. If the entity cannot be verified, if the terms do not explain the costs, if the exposure cannot be described in dollars, or if the purpose remains vague, do not treat urgency as a reason to proceed. A pause is a complete decision for today. It protects a future decision from being made by a timer, a promotion, or an unfamiliar unit on a chart. This is what practical financial understanding looks like. Not memorizing a prediction, but knowing which question comes next and which record earns the answer. Before acting, write the 5 checks in a note you can revisit: the pair, the spread, the leverage, the counterparty, and the purpose. Add the link to the actual agreement and the date you checked it. If the details change, your old answer may no longer travel. That small record turns a fast-moving screen into a question you can verify later with the bank, broker, or qualified professional who owns the next answer.
One final practical distinction: a provider can explain how its rate, transfer, account, or margin process works. It can't replace your own assessment of whether a currency exposure fits your cash needs, obligations, and tolerance for loss. Save the disclosures, compare the exact terms, and ask the responsible institution to define unfamiliar language before you rely on it. That habit makes every later financial conversation more concrete.
If this made the screen easier to interrogate, like and subscribe for the next Investing Explained lesson. In the final calculator clip, hands work beside account papers. That visible review is the right pace for an unfamiliar currency decision. The last question, what real purpose would your currency decision serve before you accept its trading risk? Bring the quote, the terms, and the right questions. Take care.